I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week. Hopefully lots of great ideas and opportunities for you popping up throughout the show. So the stock market hesitated for just a few days and then got legs Thursday afternoon, and then didn't really stop as it moved up as comments came out of our POTUS, Donald J. Trump, that his tax policy, which appeared to be delayed, now he says was going to come out in just a couple of weeks. Well, basically, I can tell you, I take my hat off to the bulls, because they really got it going in here, and we're in some kind of a melt-up as the market is moving strongly to the upside. We're, for most of the indexes, the Dow, the NASDAQ, S&P 500, moving up to new highs, up about 0.75% or a little over 1%, depending on the index, for the week. The Russell, which is gaining strength again, is just a little bit behind. You know, this is a big analytical challenge for people like me, for technical analysts, for people that are seeing the market move up simply with just some minor hesitation, no real pullbacks going on in the market at all. And you know what we do? We put in resistances, and it seems like the market is able to move up through every resistance. What I'm essentially learning here is
resistance is futile.
Yeah, that's the problem, and that is that these markets just don't pay any attention to spots that we think they're going to take a rest and potentially stop, and they just continue to move up very, very strongly. So definitely an analytical challenge. The traders are struggling, a lot of people writing me, and the investors, well, it's a bonanza. They are loving it because a market that appears to be overbought has new reason to move up and has gotten some real legs. We'll talk more about this in just a couple of moments. The dollar, small up week. We were looking for that to happen. Came up actually and exactly hit the resistance level we were looking for. Gold and silver, even though the dollar got a bit of a bounce, still strong. They moved up. Silver accelerating on Friday with quite a good day. So the metals have a lot of buying coming in. The base metals are really strong also, and iron ore has a huge recovery high after trading under $40 per metric ton, now trading at near 100. So massive moves there, and that's really helped all of the mining and metal stocks. Bond market, strong also for the week. It had a big up move early in the week and then reversed Thursday and gave up a lot also Friday, but then it had a bounce back. It is down on the day Friday right now as we're doing this around midday. So there is an odd thing going on here with everything essentially getting bought this week. Very little was on the downside, maybe a few stocks that had some bad news. Oil, small up week. It actually looked bad early in the week. Wednesday, Thursday, and Friday marched to the upside. And I gotta tell you, there's something about this pattern that's looking explosive to me in the oil market. We're looking for some upside in there, and we think that it might be a couple weeks away before that really hits, or it might be sooner. I think the risk rewards are sharply favoring the upside in the oil market. And that's despite talk of a glut out there and OPEC having made comments the week before or early in this week that they might have to tighten up their production again, but there's really a good look to the oil market right now. Gasoline really strong also. Stock market, keeps charging upward. And like I said, I'm getting a lot of emails, tweets. Traders are frustrated because to trade, if you're trading the stock market or the indexes, you actually do need some two-sided movement because at some point something is going to take you out of a long and you never get another entry to get back in on the long side, and that is frustrating. Shorts, people on the short side in the stock market, crushed. I mean, simply all of the styles that could possibly work on the short side, if you don't catch the right stock or the right moment in something in the commodities that's just having a little downtick, you're going to have a lot of struggle. And I'm getting all of those emails and comments. And people even unsubscribing because they want to just wait out this market that's untradeable. And some really good comments, too, of people that are doing well that are using our charts. I'll tell you a little bit more about that a little later in the show. So the questions that I'm getting, basically the tone, the questions that seemingly all have the same meaning is, how can this be happening? Have the rules changed? The rules of valuations, the rules of how markets move, have they changed? Well, my answer is really in some basic economics that we'll talk about right now. Let's talk about these macroeconomics. We had a major recession, bordering on what could have been worse than that. The Fed stepped in, and the Fed printed $4 trillion or more. And it was basically a rescue of the economy, a rescue of banks, fear of depression, remembering what the Fed did or didn't do back in the 1930s. And so they acted in a way to soften the blow on the downside. Now, I argue always whether or not that's the right action to take, but let's just stay in this discussion of the macroeconomics. So the banks were hugely threatened at that point. There were a lot of mergers going on. There were some banks that actually went out. Remember, Bear Stearns got taken over at a ridiculously low number, and Lehman didn't. And there was a lot of banks that went. What happened is that because the banks were hugely threatened by the economy, by their condition, they essentially considerably slowed down their loaning of money. And their loan standards went up extraordinarily compared to basically seemingly no standards at all when it came to mortgages and stuff like that during the period of the happy times in the early 2000s up to 2007. So what happened also is that interest rates went down and essentially went down to zero. So the Fed then, wanting to reinflate the banks, they, as they were buying all the bonds up and mortgage rates or mortgage notes and everything, they were putting money in the coffers of the banks. And the banks had high excess free reserves. That excess reserve, the federal government was paying them, or is paying them, 25 basis points on that. So essentially, they could get 25 basis points on all of this massive amount of money and take absolutely no risk. At the same time that their loan standards were much tougher and the economics were such that they didn't want to loan money out anyway. So what did that do? It put money into what's called a liquidity trap. So the economy is in poor shape. They're nervous about loaning out money, and the money that the Fed is creating is going into these excess reserves and staying in the coffers. And that's what Japan has done also. We've been in that condition basically for 8 years, and Japan for 25 years. So that's a giant mistake, and it really doesn't work to stimulate the economy, and you can get why. So what happened then was a lot of financial engineering. Companies would buy up their stocks. Revenues would be consistently falling, but the earnings would hold up because there was less float in the stock, and there was some M&A, and there were all the money that was being pushed into the economy, some of it was leaking into the stock market that way. So that lifted stock prices up. Then something different has happened. Donald J. Trump got elected. And what that means is that when, in theory, what happens is when you're in a liquidity trap and the government can't stimulate no matter what, because the more they print, the more it goes into the liquidity trap, then the only thing that the economists say can get you out of that would be fiscal spending. But we were in a period where there was no way that it made sense politically to increase the debt, right, to get the fiscal spending necessary. So we were stuck there, and the conservatives wouldn't let it happen, and they're really right. I believe in sensible governance, but you had this period where you're building the liquidity trap, and you've got this sensible governance going on, and you can't get out of the problem then. So Donald J. Trump is elected, and now we're talking about lower taxes significantly for corporations, bringing in money from overseas that's stuck out there. That is stimulative and really affects earnings in a positive way for corporations. We're also talking about lower taxes for everybody, and that then, of course, puts more money in the people's pockets, and it's stimulative. Plus, now taking on some fiscal projects that then can stimulate the economy also. So what happens is that the prospect of higher growth then brings you to a time when interest rates start to go up. The banks then say, I can loan money out. Corporations are looking better. People are going to have more money. Maybe that's better than the money that I'm getting from the government in these free reserves. What happens is that the money starts to get shaken out of the liquidity trap. People are looking at these valuations maybe not being that high because earnings are going to go up significantly, and investors get way ahead of it. That prevents any selling from coming into the stock market. Now, there will be moments when the stock market ticks down significantly, and moments of panic or corrections, and we'll see 5 or 10% drops, but in this environment, that's likely to be it, and then we'll have the market come back up very, very quickly, as once that moment of panic is over with, the buyers step back in for the reasons I just told you. So these questions that I'm getting is that how can this be happening? Have the rules changed? Well, the answer is really yes, because what's changed is the way the total economic or macroeconomic environment was for this last decade, and what they're looking at is the potential right now. So that's why the shorts are getting run over and the investors are happy people. You want to go back and look at some charts where similar markets occurred. I'm just talking about charts. I'm not talking about the background news, because it was certainly different. Go back and look at 1962 and 1987, final stages of those bull markets, which were both shorter than where we are right now, had significant upside moves before they had crashes, both of them. So there's a lot of upside potential in here still, just based on that mentality. So, great. I hope you understood that. I hope it was a good explanation. And it does make the case for the fact that, yeah, I think we're going to get corrections in the market, and I'm looking for 5% or more fairly soon. But it won't last, and they're likely to come roaring back to the upside after that happens. So that is a look at my opinion of the macroeconomic situation. And I will be right back with you in a moment. So let's take a look at what happened in the stock market this week as we take a peek at our 60-minute chart of the ES, the S&P 500. And you can see here the gray area is the overnight and the white area is the trading during the regular trading session. We can see what happened during the week. Well, it was basically nothing going on in here all the way through Thursday afternoon. We got some action Thursday afternoon that really stimulated the market to move to the upside late in the week. On Monday, stocks weaker. Analysts were asking, is that Trump trade over, as gold and bonds were moving up and the stock market was moving down? Got a little bit of a lift there on Tuesday. Markets were overall mixed all over the world. The dollar finally got a bounce. U.S. stocks, well, they opened up stronger, as you can see right over here. And then concurrent news came out. Betsy DeVos was confirmed, and Donald J. Trump said that he wanted to negotiate drug prices. Well, the drug companies got hit, and so did the stock market on that because, well, that's not free market. So then on Wednesday, gold and bonds, they moved up again. Oil moved down on some bad inventory numbers and some threat that, OPEC would have to cut some more if necessary. And oil never really recovered a whole lot at that point. And it was a day when we saw the stock market open on the soft side. But then throughout the day, we got a rally, which now has really seemed to become the trend. Stocks were stronger, and they jumped on that news right there. You can see as our President Trump said at that point that his tax plan was coming in a few weeks. That was a big surprise because in an interview just a few days later, he said it might come late in the year. So even he says he was hoping to get it this year, and now he says he's getting it in the next few weeks. That stimulated buyers coming in because what we just talked about is this fiscal stimulus and the effect of shaking money out of that liquidity trap, and the buyers came in and they really haven't stopped. Japan had a big day Friday, up 2.5%. Abe meeting with President Trump on Friday. The yen got weaker, and we had import prices jump. It's 3.7% year over year on import prices. Well, that's some real inflation. The bonds then did pull back after having a midweek pop, and the U.S. stock market just simply keeps churning on the upside. I mean, just some very powerful upside moves, as you could see here, as we're moving into our last hour for the day here on Friday, as the market has continued to move pretty strongly to the upside. Let's take a look at our calendar for the week, and you can see that the earnings reports are really starting to dwindle. We get Pepsi on Wednesday morning. That's one of the more widely held in there, and Deere on Friday morning. And besides that, not so much stuff that I pay all that much attention to. And as far as the economic news goes, the events, we'll get the producer price index in there and the consumer price index there on Tuesday and Wednesday. And Janet Yellen speaks. I'm not exactly sure what the topic is there on Tuesday. So those could be events that move the market. Certainly consumer prices is something that can move the market as we get some sense of maybe some real inflation coming in the market. So the main focus for the coming week is really on this stock market, and can it keep churning so strongly on the upside. What happened last week as far as the individual stocks go? Well, right now we're going to take a look at our best and our worst stocks for the week. All right, so for the best stocks of the week, we've had some really nice movers in here. I mentioned earlier about the strength in the iron ore market and how that has affected the material stocks, the miners, in the steels even, and that has been just something to behold on some of these stocks that are getting some big upside moves. We're going to take a look here at the weekly pattern in CLF, which has had just a giant move in here, and you'll see that this is our big mover for the week. Here is Cliff. Look at that move for the week. It made a really nice triangular correction that you can see in there, and then started to move up. It had its earnings report. Their earnings were better than expected, actually moved up to a profit, and then they really, I think, were benefiting from this increase in iron ore also. Here is this triangular formation right in here, it occurring during this upward phase on our cycle patterns, and then explodes to the upside, up 23% on the week, and just this giant move. Maybe a little less than that because it's giving some of it back here on Friday since I worked on these charts. So giving a little bit back, but plus 20% for sure in there, in a giant move in Cliff. Take a look at Skechers, SKX. Now this one, you'll notice I have no analysis on here at all. Their earnings were poor, really. They missed. The revenue's flat, but they guided better. And I wonder if it's just a bunch of short covering that's pushing this thing on the upside in here in Skechers. I can't really give you any great analysis in this one because, well, it just doesn't have it there. So Skechers, a 20% gain on the week. This one I do have analysis in. This is not the right symbol. It's ATVI, which is Activision. Look at that move. So I can do a little teaching on cycle analysis, and you can see here the basic, that is the cycle brackets, which are the idealized cycles. Cycles are measured from a low to low, so that is one ideal cycle right in there. And these are some smaller cycles, right, that divide it basically in half. And this is just very clear action. Bullish cycle right there. You see how it resolved itself? And then another bullish cycle came down. And when it goes lower than the previous low, the odds are that it's not going to make a new high. So this was only about a 1 in 4 probability that you're going to get that kind of a move. But 1 in 4 says it still does happen 1 in 4 times. And you got that giant upside move there in Activision. Earnings, a big beat. Dividend increased. And a buyback. And that really did help the stock. Take a look at LPX, which is Louisiana Pacific in the building material category. How do you like that for a move? Some 15% up on the week. And again, a pretty similar pattern to the one I just showed you, in that you have this kind of corrective flag right in the middle of this pattern right there, and then breaks out of that downtrend and accelerates to the upside. And their earnings were a big beat, and you can see that big upside move in there. Next one we're going to look at is Deckers, DECK, and this stock getting a big bounce, 13% on the week. You know, this has been a troubled group. There's been, what happens is when the price gets so cheap, then you start to hear about activist investors, you get to hear buyout rumors, and in this case, Mikado took a 6% stake, and that looks like a bottom to us. Now, it's still not a great pattern. We'd probably look for it to get a bounce up into the 56, 57 area based on this rising phase, but then we don't think it'll do much better than that. We'd be a seller if we were long the stock and it got any further than that. Next one we're going to look at is PNRA, which is Panera. And take a look at this stock in Panera and what looks like a very, very big megaphone. Now we're jammed up there on the computer, so I'm going to take a second and let it free itself up. This group has been interesting, and I did a special video on it this week, along with retail and steel stocks. And there is some stocks in here in the group that are quite overvalued, and I would say this is one of them, trading at about a 26 or 27 forward PE, and there is a big megaphone in there, and you can see that as it just now gets up to the top right over there. Our pattern is suggestive of this stock stopping in this area and then going into a correction and then trying that level again. That's this pattern that you see right in there. So we would not buy it here. We think it's, if anything, a short for some kind of a corrective pullback. and that would be something for brave traders that are interested in, I think, what is a high potential of a stock pulling back. If you're a member and you have not seen our video yet on the retail and the steel stocks, then take a look at that. And I mentioned another very, very overvalued stock in the restaurant category that you're going to want to look at, because I think it's a good opportunity. All right, so one more thing we'll look at, as I mentioned, the steel stocks. And again, I want to put up U.S. Steel, which has had a very clean breakout into a new cyclical pattern. You can see that right there. And that is a bullish cyclical resumption, and very likely to go to higher highs. It likes these higher iron ore prices, and certainly the prospect for more economic growth and fiscal stimulus. Here was the low period right here we were looking at, and here is the upward turn, and you can see that right in there, not timed badly at all. Comes down, pulls down to the intermediate 30 at 2.8%, and then surges on the upside this week about 9%. Big up moves in that group in steels as they have continued to do well. We have Steel Dynamics and Nucor and Schnitzer all up 7%, so getting nice gains in there. One other stock to mention that has had a big gain, and that is Sears SHLD. It is up. It was up at one point overnight, I think 40%. It opened up about 30% and backed off some, I think 25% now on the day, on the fact that they're cost cutting and restructuring again. So you know how I feel about that stock. It got a pop into the 7s. I don't think it's got much more, maybe a little more, but overall, lots of trouble for that stock and JCPenney. That is the best of the week, and coming up is the worst. All right, the worst of the week, we're going to put up Yelp. Yelp moves to the downside by 13%, and this is a stock that we have loved to hate. And it's last year it was on our list of worst for the year, or was that the previous year? I can't even remember. How do you like that? Anyway, it did do poorly at times when we thought it was going to do poorly, and we caught some beautiful trades in there, and now the stock really looks like it's in trouble again. Moves to the downside as earnings beat, but their guidance was really soft. And that you can see makes this double top right over here, and then turns to the downside. It's right here on that 34-week moving average. You can see it right there. It hit our first target right there on the downside. We had a bearish trade right over here, and now we actually think it's going to hit the second target under the $29, $28 area there, as our projection is now to the downside in this stock. You can see in here this was really nice candlestick action, and here, well, how about this? You have this dark cloud cover, but it doesn't break below the slim ribbon. You have the gravestone in here, and it still continues to the upside. And then you have this called this Harami cross and this inside down, and that did break it. Unfortunately, we didn't really get a negative momentum signal, but you see this big gap, and that big gap really is saying that the upside trend in there is over. There's always the possibility of some buyer coming in there and changing the tone, but overall, this looks like a really bad stock. Cree is a stock that is on our list of the worst 18 stocks for the year. And you can see that right in here. We'll say that I said it was the riskiest, and it may end up to be one of the worst. As the stock is now down on the year. That stock, analysts have downgraded the stock, and we think that it's going to continue down and test at potentially the $20 level and that stock is not in good shape in there at all. GoPro down about 8%, and there's disappointment about their new Hero camera, I believe, and Gilead down about 8%. Now, this has been a very negative pattern also. As a matter of fact, once they started to talk about competition for their key drug, then it got into this, notice the cycles and the stair-step downward movement. And then as it breaks each of the important cycle lows, it continues on the downside with confirmation. And then you did that right over here, and then you get the big downside move that isn't scheduled to end until March. So Gilead continuing on the downside in there, as their earnings beat, but their guidance really missed, and analysts just wailed on this one as far as downgrades. So that is a look at Gilead, the last stock we're going to look at in this category. A category that really has seen a lot of buying coming in this week is the retail, and this is Coors. And this is a stock that we have had negative also. You can see that it has been in this downward projected area that also continues down until March. And that really has us suspicious that any attempted rally in here really should be sold. So Cree is another stock that is not looking great at all. So that is the list of our worst stocks for the week. Now, what we always do after that is get into our short-term view, which we're going to do right now. So we have had some amazing emails coming in from some of our viewers and subscribers. WW wrote me, and he said that he had to compliment me on the wisdom that I share in all corners of the market, as he put it. And he is he sees our videos at TheoTrade, which is one of our partner sites. Great site. Go look at theotrade.com. So really pleased to get that kind of email. I got an email from a subscriber who's been with me a long time, TC. He said he's been using our charts. He's a level 4 member, and that he says that based on using what the information is on our charts, he says he's already up over 7.5% for the year in his longer term accounts. How's that? Just absolutely fantastic. And I got an email from RW today. You know who you are. He says that the amount of money that he paid for my chart subscription, that would be our level 4 subscription, he's made 30 times that amount already this year, just based on the information that's on our charts. You want to become a level 4 chart subscriber, go to our website and look in the membership area, and you will see that you can check us out for a month. And if you subscribe for 3 months, you will get our market condition indicator. Our market condition indicator is a proprietary indicator that tells you the condition of the market, and it's really valuable. You can go on our website and you can watch a video, and you'll understand then how the market condition indicator works. If you have any questions, write me at slim@askSlim.com. Give our charting service a try. I think you will love it. It's for the TOS platform. All right, so now let's get into our short-term view. And we're going to do that by looking, as we always do, at the S&P 500 on a daily basis. And we will take a look at, first, what I said for the last week. So as far as how I did for the last week and our projection, not so good. What I expected to happen was that we would get a rally, and that the rally would come after a dip to 2280 on the S&P 500. It dipped to about 2285, pretty close to our support area. So it didn't get quite as far on the downside, but not so bad. The rally, I said, would stop 2303 to 2305, and it has moved through to more like about 2318. So the pattern, the shape of what we were looking for, and the levels that we thought it would get to, not so good. We missed by a little bit on the low side, but it is much stronger than we gave it credit for. And now we've put in some resistances a little bit higher based on the real short-term targets that come out of Fibonacci extensions. I'm going to show that to you and give you an idea of what we're looking at next. So this is the daily chart of the S&P 500. As you'll see right in here, we had this part right, that this was the 20-day low, and that we were in this rising phase. We thought that this pattern in here was going to do this, get up to the 2305 area and then roll over. We did not give credit to the change of the tax plan and the stimulus that would come as far as how early that potentially could come. And that gave the lift to the market right over there. So the pattern that we were looking for timing-wise is still in place. So in other words, we were looking for the decline to go into the early part of next week, and that remains. So we're looking for a dip in here. It could get as low as this support area right there, which is on the downside 2300 to 2294. But then we would look for another rally. Now the upside resistance based on these Fibonacci extensions that come off of these daily cycles is up here right in that area. So we think that this area of around 2323 will stop the rally. There's a potential for this next one up here at 2333, 10 points higher, but certainly that's the zone I think that for the near term is going to stop this rally. So for the next week, we're looking for 1 to 2 days down right in here, and then another rally attempt. That is likely to give us a relatively small changed week. As you can see, didn't mean to pop that up, but we'll get that back. Relatively small changed week as we're looking for a dip and for a move back to the upside. That's, well, not good news for the traders that want to see a big decline in the market. This pattern just doesn't quite set that up yet. Set up for more like about 8 days away. We looked at our VIX pattern, and if you become a member, you can see our analysis on the VIX and the 5 major markets coming up a little bit later in the day. We do that, and that will you'll be able to see the VIX in there and why it points to the fact that the stock market isn't quite ready to give it up yet, and it points, pretty much to maybe a little bit of a correction in the stock market, but then trying to get to the upside again. That's it. That's everything. I hope you found it enjoyable, especially my comments on the macroeconomics. Hope you have a great week, and you be careful because it is dangerous out there. We're always wishing you great trading.
Well, I'm going to